I do think that we are headed into a global recession. But remember that recessions don't, the markets don't trade in a straight line. So you're going to get to these technical levels where people get overly bearish, and then you get these technical bounces, like for instance, when the Bank of England does something like this. And then what you'll see is people start to sway and start to get bullish again. And then as soon as they start getting bullish in a bear market, you have to be on alert that it's likely not going to go too much further. So I don't think, for instance, a one-day bounce is all we're going to get here, but I certainly do think we are going to go lower across the board on all stock markets and really start to head lower. I'm kind of isolating down, and I can show my S&P chart here.
Sure.
SPX. There's a pivot point that I'm watching. So number one, notice where we bounced today. We bounced right at the lows from June. So a technical support level right there. I think this is a short-lived bounce. You might get a week, week and a half, 2 weeks out of it. But ultimately, we have to go retest the pre-COVID collapse highs right here. So that's down around 3370 on the S&P 500. And that makes a lot of sense, right? If you think about the Federal Reserve sucking all this liquidity out of the market, it makes sense that we have to go back to the pre-period before all this liquidity was put into the market. So that would be my next stopping point. I think by year end we get there.
And that is your fundamentals coming into the market. Just to add that in, because we often talk just about technicals, but that's basically a fundamental piece.
Right. That is true. That is true. Just sucking out that fundamental money that was printed. I also think at a basis, I'm going to be looking to buy this level right here just because it is such a psychologically technical level right there. So there'll be a bounce off of that. But again, I'm in the camp where you're going to have two cycles to this bear market. The first cycle we're in right now, which is a cycle where the Fed is tightening, there's no more money printing, and so valuations have to come down. The second cycle is going to be after the Fed pivots, right? So the Fed is going to eventually pivot. We saw kind of the Bank of England already do that, right? So at that point, you're going to see a big bounce in the market because the Fed is pivoted. Everyone's going to say, oh, they're going back to easy money policy. I don't agree with that. I think the pivot is basically just not hiking rates anymore. And the next cycle is going to be when the economy slips into a recession, and that without Fed printing of money, if you think back to every past big market drop, whether it's a recession or it was COVID or whatever, the Fed has been printing us out. And so with inflation still staying above 4%, I have a long-term horizon of like multiple years where inflation is going to be 4% or so. The Fed cannot print us out of the next recession, and the market is eventually going to realize that. And that's going to be a big earth-shattering factor for the overall market, where they're like, wait a minute, how does the economy get out of this recession without the help of the Fed? And that's where you see that next leg down where people say, okay, now we could be in a recession for years. I mean, it could be a multi-year recession, not just a 6 or 12-month recession period.
And looking at that support level there, if that was to happen sooner, say in a week or 4 weeks, if we just get that quick flush dump out of it, would that then change your mind in terms of timing? Or maybe we hang around those lows a bit longer and form a base?
Yeah, so overall, to me, the speed at which it comes down just would dictate how big of a bounce we would get off of it. So the faster it would fall, like for instance, if we were to go straight into it, let's say in the next 2 weeks, I would actually look for a pretty solid bounce back to this pivot high right here, or this pivot low. But overall, it wouldn't change the aspect of what I'm seeing in the charts, right? It still wouldn't change anything about what I'm looking for, where I still think we have to go at minimum down to the lower end here. And I want to show you this trend line. This is a pretty powerful trend line here to see. And look at this one right here. So this is another major trend line, where this is a long-term trend line where you could actually extend this out to 2009. And basically that is the long-term trend of this market. So just because we're going to 3370 or so, I still think we have to go even lower before you get to any sort of longer-term bottom in the market.
Yeah, if you did extend it out to 2009, I mean, I use a bit of GAN analysis and looking at the 50% from the low to the high, which I do on my channel a fair bit. I think it comes out at around 2,700 points. And so just looking closely at yours, it was about 27. And then I'm also looking at 32, which was the bottoms, 3,200 points just underneath the September lows there in 2021. So it's similar to your 33 there.
Yeah, and I love that, by the way, that you're a technical guy, so we speak the same languages. It's very cool.
It makes it so much easier because you just know that there's going to be these levels eventually come up, and provided it stays within that zone, for me, that's like the stronger half. If it starts to drop below those significant key macro support levels of multi-years, that's the real weakness. Whereas for now, it's like it's just a correction, the way I see it anyway, a correction in a bigger cycle.
Yeah. Absolutely, absolutely. So I think the bottom line is, I mean, and this is the thing though, is a lot of people out there will hear this and they'll be like, "Oh my goodness, this is horrible. We're going to keep going down." But honestly, there is so much money to be made in this market because when you do get bounces in bear markets, as you know, they're huge bounces. So you just really, it becomes a market where the good investors and traders that can read the charts can time the market much better. But when you get these bounces, they are tremendous, and there's a lot of money to be made both on the long and the short side.
You mentioned something about like a multi-year bear. What does that, I guess, entail? Because I've seen that in headlines, from other interviews, and news outlets are going to use it, and all these sort of guys are going to use it. But does that mean this market just goes down and down and down for years, or does that just mean that we stay underneath the previous old all-time highs for years? Like, how do we define that so that we're not getting scooped up in super big headlines?
Yeah, so and again, I know that sounds really scary, but like I think the best thing to do is look at like other markets that have gone through this, right? So number one, if you looked at the Nasdaq in the .com period, it had this insane move. In fact, let's go to that now. In fact, let's take a look at the Nasdaq chart, and then I'm going to go to the monthly chart just so we can see back to 2000. And what you can see in 2000, it was very similar to the vertical nature is kind of what we've seen here. I mean, look at the vertical nature here. And by the way, look at how big this is compared to this. I mean, that's how scary this market is. But as you can see, I mean, you had generally a pretty big drop, but there were some big bounces along the way. And then you went into this kind of sideways to up, like almost like a bull market within a bear market period where you actually could make money by just going long. Just the highs were not taken out for 15 years. And I think another good example of this would be like the Hang Seng market. So if we look at the Hang Seng market here, which is the Chinese stock market, and we look at this, right? So here in 2003, the Hang Seng market had this insane run. You then had this epic collapse, but then look at the market since then. I mean, it gave plenty of opportunities for these ups and down mega moves where there was lots of money to be made. It just never really took out the highs and broke higher. So, I mean, if you're looking at the China stock market here, I mean, you could have gotten in at the highs of 07 and you're still down significantly on your money. And this is kind of what I expect for the US stock market to go through this period of digestion. Another good example of this would be the EWZ, which is the Brazilian ETF or the Brazilian stock market. And you can see here, look at this mega move from 2003 to 2008. And then you had this epic drop, which is kind of what I think is going to happen in the next, between what we've already seen in the next 12 months is what I'm envisioning for us. Then you're going to have these big bounces, but generally the market is trailing lower here. So I think, for me, this is kind of a good playbook for what I think the U.S. stock market and some of these global stock markets overall that have had big bull moves will probably go through.